to Good Money Moves, the show where we provide you financial tips and advice to help you feel financially empowered. Today we are talking all about the home buying process, and with me is Andrea Allen, our Chief Revenue Officer here at First Alliance Credit Union. So thank you so much for being here, Andrea. We are really happy to have you. Why don't you just kick it off by telling our listeners a little bit about yourself, your role at the credit union, and a little bit about your career.
Of course, thank you. So like Jenna said, I'm the Chief Revenue Officer. What does that mean? I essentially look over everything that touches members within the credit union. So all of our lending channels, from real estate, commercial, and consumer lending, help support the branch staff and member experience, new accounts, anything that really that you're interacting with when you come into the credit union are part of the teams that I work with. Mm-hmm. So we call it revenue, but really when you look at that title, we just look at ways that we can be sure that we're using our members' money in the best way for them and for the credit union to be able to grow and provide more access to some of our team members. I have been with First Alliance for a little over 6 years. I've been in the financial industry, everything. I started at a graduate high school, actually, as a teller till now, so a little over 20 years. Yeah. Not to put...
You were my teller.
Yeah, was
at
I?
times, yeah.
Oh, funny.
Because we grew up in the same town.
We did.
So, yeah. Yes, yeah. Awesome. So you know your stuff, it sounds like.
Well,
sure.
I hope so.
Awesome. Well, let's just jump right in and start with, like, if someone's considering buying a home, there's a lot to think about, but, like, what would maybe be the steps they should be thinking about to really start to prepare for that home buying journey, like before they even talk to someone?
Great point. The first thing that's really important is knowing where you stand on your credit. If you're going to come in and try to get pre-approved for a mortgage loan, you don't want to be surprised by what's going to show up on your credit. So just be sure you're keeping a temperature on where your credit's at with your payment history and stuff. You can use some great tools for that. Within First Alliance, we have Credit Sense. That's what I use to keep track of my credit score within my mobile app and online banking. It shows me where I'm at from a score perspective. And if it ever moves, I'm like, whoa, what happened? And I can go in there and see maybe what took place. So that's the first thing, is just to really have a good understanding on where you're sitting there so you're not surprised when someone pulls your credit and what shows up on it.
Yeah, that's really good advice. I think credit score is probably a huge component to that in any lending, really, not just home buying. What about things like income should they be thinking about when it comes to preparing to buy a home? Is that a factor they need to be considering?
Great point. Depending on where you're at in considering the home buying process, making a career change can sometimes be a hurdle then if you go and apply for a mortgage. So we were actually working with a member recently who was wanting to get qualified for a loan, and their one of the spouses in the household just quit their job to start a business, which is amazing for them. The hard part on that is that now there's no verifiable income for them to use to get qualified for a mortgage. And most conforming mortgages are going to need at least a 2-year work history. If during that process you change jobs, but it's the same career path or you were in school and now you're working, as long as it's consistent, that's going to be okay with you. But they do look for some stability in employment.
Awesome. Yeah, I think that's a really important point. So let's say everything's looking good from credit score and income standpoint, and the person is feeling kind of ready to really take that next step. Who's the first person that they should reach out to? Do they talk to a realtor first? Did they come and talk to the credit union first? Is there someone else they should be talking to before they even start this journey? Like, what's that first step?
Great question. The first step I would have is honestly a conversation within your household. If it's just you, that's fine, but just be sure you're on the same page on what you're expecting to come out with. The top conversation I would have is, what can we afford a month? A lot of times the conversation comes like how much of a house I can buy. Sometimes if you're looking at a dollar amount, though, for a purchase price, you're then getting backed into a payment, which might be a big sticker shock for you when you realize with a $400,000 house, what that means for a payment or at any level. So once you've had the discussion in your household to know what can we afford a month, then go to the credit union, talk to a lender, and talk about what that means that you could get qualified for within the payment you know you're comfortable with. Knowing that payment is likely going to include not only the loan payment, but also what we call escrow, which is going to be your property taxes and your homeowner's insurance, because then that's going to add that on top of that payment too. So really come in confidently saying, this is what we feel comfortable affording, even if it's a range, maybe from $1,200 to $1,400. And then we can help work with you on what that would equate to in a loan amount. And then what that loan amount would equate to in a down payment. Because sometimes you might go out first, if you're starting to look at homes, before you've had that conversation, it might end up being like, oh, we were looking at these houses that I fell in love with, and we realized that in actuality, maybe that payment really doesn't feel comfortable for us. So it sets you up for success when you go to start looking for a house. You can set those boundaries to say, you know what, that $400,000 house looks great, but we know that we can actually afford the $300,000 house. So it gives you that confidence to know what to look at that's going to be comfortable for you and not maybe what someone thinks you might like.
Yeah, no, that's a really great point. I remember, and this was quite some time ago now, when I was home shopping and I had done what you suggested. What is that kind of budget range that you actually feel comfortable with? So then when I went to go speak with the lender that I was going to be working with, they had actually approved me for a significant amount more than what I actually felt I could afford and manage from a budget standpoint. So that's a great point to make, to really understand your budget first as a starting place.
That's a really good point, because if you just say, how much can I get, someone's going to max out your qualification typically. So on a mortgage, you might have a maxed, what we call debt to income ratio, and they're going to say, well, you can afford up to this. Well, what do you look like on a ratio and what's comfortable to you aren't necessarily the same thing. So you need to be really confident in, I will feel comfortable with this.
Yeah. You don't want to have more house than you can. You don't want to be house broke, I think is what they call that.
Exactly right.
So, so once you've kind of figured out your affordability, you've maybe come in and talked to a lender about it. What is that outcome that you're going to get walking away from that with the lender? Is that when you get kind of pre-approved at that point, or what does that look like?
Great question. So typically in your first interaction, it's kind of an interesting distinction in the when it comes to a mortgage. They'll probably give you what's called a pre-qualification. And a pre-qualification means it doesn't go through any underwriting. It just says, based on the information provided, this is what we think that you'll be able to get pre-qualified for. So that could give you some empowerment to take a letter with you. So now you have a letter with you that says, I could be pre-approved up to this dollar amount, and that provides you some leverage when you're going to take the next step in the process. And then that letter, that pre-qualification, will be pending full underwriting. So then once you say we're ready to go, then you're going to have some additional steps after that. But you should feel empowered to know, here's what I can afford. That's what that means for a dollar amount. And then I have a piece of paper here that might provide me some leverage when I'm ready to go start looking.
Awesome. So that pre-qualification is really an important step in the whole process. You don't want to skip that part.
Absolutely not. And I say that same thing too. You just don't want to get false hope in meeting with a realtor and going and looking at homes, because if you put down a purchase agreement and maybe you put down earnest money, which is like that essentially could be as little as $500, but that's still money that you could lose if you aren't going to be able to follow through with the purchase. So knowing what you can get qualified for is so important. Take that step first, so then you're going into that next journey of searching based in reality and what you're comfortable with, and some confidence that the process is going to go through to fruition, and you're not then going to come to a lender and find out, I signed a purchase agreement and I don't qualify for a mortgage.
Yeah. It's almost like putting the cart before the horse a little bit if you don't have that in place.
Absolutely.
So we've kind of talked about credit score being important for getting qualified for a mortgage. We've talked about income. You mentioned debt to income ratio. Are there any other factors that somebody should be thinking about or considering, or that our lender is going to be looking at when they come in to get qualified for a mortgage that somebody should be aware of?
Great point. I would say you hit on a couple of the big ones. So some of the big factors that are looked at in a mortgage loan are going to be that debt to income ratio. So that just means, what monthly debt obligations do you have in comparison to your monthly gross income? On a mortgage, that's typically going to be around 45% as a max. They're going to see that be 45% or less. The next ratio that you're going to look at is loan to value. Well, what does that mean? It means how much is my loan compared to the value of the home I'm going to be purchasing. So like rough math, for example, if I'm purchasing a home, have a loan for $100,000, or the home I'm purchasing is $100,000, and I have a loan for $90,000, that's a 90% loan to value. That's important to know because really where that loan to value comes into play will be an indication to you on what your down payment needs to be.
Sure.
So depending on the loan program that you go with, you're going to need to understand what your max loan to value is because you're going to have to likely come up with that difference or maybe find a first-time home buyer program that can give you assistance on that down payment. That's going to let you know that too. Credit score is going to be a factor not only in qualification, but working on that credit score is important when it comes to your pricing. So a lot of the rates that you see put out there for mortgages assumes really best case scenario.
Yes.
It's going to assume you have a great credit score, a strong loan to value. And so if your credit score is going to be lower, that pricing that you see out of the gate is going to start ticking up based off of that as well. So that's why it's important to, to try to work on that and be aware of that as you go into that process because it can add to your pricing on the loan.
Yeah, no, those are all really great points. But one thing I want to circle back around to, you mentioned down payment.
Yes.
So let's talk a little bit more about what that should look like, ideally, and maybe what is more realistic, what you're maybe seeing most people coming in ready to put a down payment. Like, what does that look like?
For sure. I would say the simplest, most basic conforming mortgage, which means it can go through one of those basic mortgage programs like a Fannie Mae or Freddie Mac, is around 3.5% down, which we hope is like pretty reasonable as an entry point. I will say there are a lot of first-time home buyer programs out there that could maybe get you into a position where you don't have to have any down payment. There's also a product called a rural development loan, which only qualifies in certain communities, but that one you can get into without a down payment as well. What I caution people for with no down payment is it kind of ties you to that home for a period of time. I was actually visiting with a member recently who is in a position to maybe want to move because maybe where they went isn't working out or some life circumstances happened and now this payment's not affordable for them anymore. But they ended up getting some programs where there's now grants tied to their loan and their max. So they essentially, even though they're not repaying on those grants, they have to pay them back if they sell the house.
Sure.
Because some of those grants are only forgivable after a certain period of time. And so you want to just be careful with down payment. It can be a great program to not have to have a down payment. But even if you don't have a down payment, you want some sort of a savings plan. And I think that sometimes is you want that cushion for yourself that either you can exit the home if something happens in your life that requires you to do that, or that you've got some money on hand to help aid in that process in the beginning. Because I know if you own a house, your mortgage payment's one thing, but when your appliances start talking to each other and your furnace goes out, or your AC, and more than one will go out at the same time.
Yes,
it's just how that math works. That can be, when you're renting, that's not your problem. Someone else is going to come and fix that for you. But as a homeowner, that's on you to come up with.
Yeah, that's a really great point. And I think what it brings to mind for me is like I was always told, you need 20% down to buy a home, which these days is almost insurmountable for some people. Absolutely. So to know that there's programs out there where you can do as little as 3.5%, or for some people who can qualify, even though there may be some caveats and things to consider with those grant programs, still there's options for home ownership for people that I think everybody needs to be aware of. So that's really good to know. And that actually makes me think of another component that really surprised me when I was buying my home, and that's private mortgage insurance. I was so mad when I found out about that. Can you talk a little bit about that and when it's applied to a loan and when it's not, or how you can even get rid of it if you do have it on
That's a really good point. And that's where when you said 20%, that's what stuck in my head. 20% is that magic number that if you have 20% down, you're only going to be at an 80% loan to value. Then you don't have PMI, which is that private mortgage insurance. So what private mortgage insurance is, if you're going to go with a conforming mortgage, which is 99% of the loans you're going to look at, is whether it's FHA or VA or Freddie Mac or Fannie Mae, those are all the names that you're going to hear come out. Those are the mortgage programs that are typically available. What private mortgage insurance is if your loan to value is greater than 80%, you're paying a premium on top of your payment for private mortgage insurance. To Jenna's point, the part that you think is like, oh, yay, what's this insurance for? How does it benefit me? It's not for you.
It doesn't benefit you at all.
It is actually insurance for the mortgage in case you were to default. It adds some protection for the lender. Yeah. So a lot of those conforming mortgage programs say if we're at higher than 80% loan to value and we're going to take this risk on you to have a higher loan balance compared to the value of your home, we're going to require you to carry this insurance and pay the premium in order for us to feel more comfortable in our risk with the loan. Yeah. It's very standard. It can be very frustrating to your point, and it's definitely one of those things that I worked for. Like when I saw that to my first home, I'm like, I'm getting this loan to value under 80% so I can get rid of this PMI. Most mortgage programs have a certain loan to value where it's an automatic cancellation.
Oh, good.
If you request it before it gets to automatic cancellation, you'll probably have to jump through some hoops, like potentially order appraisal. Some people might say you have to kind of wait till you get to that point. But usually 79 or 78%, that'll automatically fall off for you. But it's important that you ask that question because different loan programs can look a little bit different. And we talked about that payment affordability, that PMI gets tacked on there too. So then when you're talking about how much I'm comfortable paying for, that's that number that maybe surprises you.
Yeah, it shocked me, for sure. So let's maybe talk about the fun part of home buying, and that's when the offer you've made on a house is accepted. What happens next?
This is probably also one of those things, very exciting.
Yeah.
I think it can also be a little bit overwhelming, right? Because now things are moving. We're going to order an appraisal. Do you need a property inspection? Kind of considering some of those aspects as part of protecting you as well. So then once you get that signed purchase agreement, you're going to want to bring that to your lender that you went to get pre-qualified for. And then now they're going to really start ramping up the loan process. So those documents that maybe we didn't need to get you pre-qualified, we're going to need to collect now. There'll be tax returns and W-2s and insurance information, those extra level documents to go through full underwriting. You're going to have an appraisal order that's going to go out to that property you're purchasing and let you know what the value is. I think sometimes a big misnomer out of the gate is that oh my gosh, my appraisal came in higher than I'm purchasing the home for. Maybe that'll mean I have to come in with less. It's not very common in this day and age for an appraisal to come in higher than your purchase agreement, but if it does, they actually use the lower of the two.
Okay.
So that's kind of how they level that out. It could be helpful in the future, if maybe you got to purchase a home from a family member and they truly did give you a little bit of a discount. Yeah. But just know when it comes to all the numbers on your loan, they're going to be looking at the lower of those two. Sure. And don't forget about home inspections too. I think when the buying environment is really competitive, you can often find people like, oh, we don't need to get a home inspection. And that's your decision to make, but know the home inspection is for you. So be sure it's someone that, you trust, has a reputable business, and it's really going to go in and tell you any red flags you need to know about this home. And so you can write your purchase agreement pending an inspection. Again, not required most of the time, but just consider it. That's your choice to make for yourself to be comfortable knowing that you're not going to come into this home and maybe the furnace goes out in the first 2 months. They're going to look at all of those components, and it could give you some leverage to go back and say, this actually did happen to me when I bought our first house. The furnace was at its end of life.
Sure.
And so we were able to go back and negotiate splitting the cost of a new furnace with the seller, which made a big impact for us because I was 23 years old, expecting our first child, and I know I wouldn't have been able to afford that furnace in the first 2 months of living in that house if we hadn't known about it in advance.
Yeah. No, that's a really great point, the home inspection, because when we were buying our home, that opened the door for us to have some conversation with the seller even to say, are these things you're willing to fix before we take and actually purchase this house? And there were some small things they were willing to fix, which was great because it's like, to your point, you're young sometimes when you're buying your first house. You can't afford out the gate, especially when you're talking about having, closing costs on top of everything that, which let's maybe talk a little bit about that because I don't think you mentioned it,
Yep.
closing costs and escrow and all of that. How does that work? What does that look like on a mortgage?
Great question. So closing costs are going to include, a lot of it is hard costs. So these are costs it cost your lender to produce your loan and things you need in order to get your loan done, right? So the appraisal is going to be part of it. Maybe it might include property taxes, depending on when you buy your home. You might split that they pay half and you pay half. Your first year of mortgage or homeowner's insurance could be included in that. Title is a big one. You're usually going to see that come across as title insurance. The reason that they do that is that a title insurance really just means for the lender that title company is insuring your lender's position on the title of your home. So when they file their mortgage, the title company is guaranteeing that you're getting a free clearing title to your home, and that everything else that was on it before is cleared off for you to clearly get ownership of your home, and then for your lender to know that they're going to be in that lien position for the first lien position for a first mortgage. That can be a little bit of a higher chunk of that. And then you'll also see some pieces about, maybe doc prep fees, underwriting fees, origination. And those, again, might look like some soft fees, but they're usually to cover the expense that an lender has to originate that mortgage. Because oftentimes if that lender is originating a mortgage that's a Fannie Mae, well, that's the investor. So your credit union has that loan. They might keep it and service it for you. However, they're not really the end game. So that origination is sort of where they get a little bit of their funds back in the cost of insuring the loan. So the things to look for sure is compare some of those fees, like the origination, doc prep, underwriting, points paid. Some of those pieces are things to look out for. So you should get what's called a loan estimate. When you are ready to take those next steps, you have a house and address picked out. That loan estimate is going to give you all of those fees.
Okay.
It's really important to look at that. And that's what the intention of that is that I could go to another lender, I could apply with them, and I can get that same form from them, and now that allows me to compare the fees side by side.
Sure. So it really helps kind of just break it down for someone who maybe isn't as familiar with these terms and what they're looking at. So it just makes it easier to do a little bit of comparison shopping and make a smart choice for yourself.
Absolutely. And the biggest thing to keep an eye out for is rate versus fees. For the most part, if your loan's going to end up with FHA or Freddie or Fannie or one of those investors, at the end of the day, the rates are pretty much the same, depending on who you go with. So if someone's telling you you can get 0.5% less than the person over here told you, they might be making up for it in fees.
Sure.
So it's still probably baked into your loan somewhere. It's just going to come across in a different area. And that loan estimate will really provide you the opportunity to look at them across the board and kind of compare apples to apples. Maybe give you an idea on what you're going to have to come in with money, what that total amount is going to look like. But it's meant to even the playing field so that one person doesn't explain it to you one way and one person another. You have the same form that you can compare side by side.
Sure. That's really great advice, and I feel like we could talk about this for another hour. There's so much that goes into home buying, but we are at time. So Andrea, thank you so much for sharing all of this great information. I'm sure we'll have you back to share more because, again, huge topic to cover and so many things we could talk about. So thank you so much for tuning in. Before you go, make sure you check out our website at firstalliancecu.com. You can get more free tools, more resources. You can schedule an appointment with our team, and they're here to help you start making good money moves today. And don't forget to hit subscribe so you never miss an episode of Good Money Moves. See you next time.